Welcome to HIFCL's YouTube channel. In this video, you will learn about the top interview questions for Basel III. So, let's get started. Question number 1. What is Basel III? The answer is Basel III is an internationally agreed collection of measures which are developed by the Basel Committee on Banking Supervision in response to the financial crisis of 2007-09. Question number 2. What is bank regulation? The answer is bank regulation is a type of government regulation that subjects banks to specific restrictions, requirements, and guidelines, designed for creating market transparency between banking institutions and the individuals and corporations with whom they conduct business, among other things. Question number 3. What do you mean by the Basel Accords? The answer is the Basel Accords are a series of 3 sequential banking regulation agreements, Basel I, II and III, set by the Basel Committee on Bank Supervision. The committee provides recommendations on banking and financial regulations, specifically, concerning capital risk, market risk, and operational risk. Question number 4. What are the pillars of Basel III? The answer is, Basel regulation comprises 3 pillars concerned with minimum capital requirements, supervisory review, and market discipline. Question number 5. What are the common ways to design a revenue schedule? The answer is, some of the common ways are: first, sales growth; second, unit volume, change in volume, average price and change in price; third, inflationary and volume or mix effects; fourth, dollar market size and growth; fifth, volume capacity, capacity utilization and average price; sixth, unit market size and growth; seventh, product availability and pricing. Question number 6. What is a SIC unit? The answer is SIC industrial company basically means an industrial company that has the accumulated losses in any financial year equal to 50%, or more of its average net worth during 4 years immediately preceding such financial year, and failed to repay its debts within any 3 consecutive quarters on demand made in writing for its repayment by a creditor or creditors of such company. Any one of the above 2 criteria is sufficient to consider such a company as a SIC industrial company. Question number 7. What role is played by the HIFCL? The answer is India Infrastructure Finance Company Limited is owned Indian government. To provide long-term financing to infrastructure projects in India, it was set up back in 2006. HIFCL has surplus funds of 20,000 crore. It started a takeout financing scheme in October 2010. Question number 8. What do the credit rating agencies do? The answer is rating agencies help in providing trust and confidence in financial markets by rating borrowers on their creditworthiness of outstanding debt obligations. Question number 9. What are the Basel norms? The answer is, the Basel norms are an effort of coordinating banking regulations across the globe, to strengthen the international banking system. Question number 10. What are the different kinds of financial ratios? The answer is, the 5 kinds of financial ratios are: first, liquidity ratios; second, efficiency ratios; third, profitability ratios; fourth, market valuation ratios; fifth, leverage ratios. Question number 11. What does risk mitigation refer to? The answer is risk mitigation is defined as the process of reducing risk exposure and minimizing the likelihood of an incident. It entails continually addressing your top risks and concerns to ensure your business is fully protected. Question number 12. What do you mean by credit risk modeling? The answer is credit risk modeling is a method that is used by lenders in order to determine the level of credit risk associated with extending credit to a borrower. Credit risk analysis models can be based either on financial statement analysis, default probability, or machine learning. Question number 13. What are Basel III new liquidity risk measures? The answer is the Basel III LCR standard is designed in a way to ensure that a bank is maintaining an appropriate level of unencumbered, high-quality liquid assets that can be converted into cash to meet its liquidity needs for 30 days under a severe liquidity stress scenario. Question number 14. What was the reason behind the implementation of Basel III? The answer is Basel III was implemented to improve the ability of banks to handle shocks from financial stress because of the impact of the 2008 global financial crisis. Question number 15. What is the solvency ratio? The answer is The solvency ratio indicates whether a company's cash flow is sufficient to meet its long-term liabilities and thus is a measure of its financial health. Question number 16. What are the basic concepts of finance? The answer is, the three main concepts of finance are: first, financial management; second, financial markets; third, institutions and investment. Question number 17. What do you mean by CDS? The answer is, CDS stands for Credit Default Swap, that is a financial derivative or contract that allows an investor to swap or offset the credit risk with that of another investor. Question number 18. What is Basel I? The answer is, Basel I is the round of deliberations by the central bankers around the world, and in 1988, the Basel Committee in Basel, Switzerland, published a collection of minimum capital requirements for banks. Question number 19. What is risk weight percentage? The answer is, risk weight percentage refers to the total assets owned by the banks. However, the value of each asset is assigned a risk weight and the credit equivalent amount of all off-balance sheet activities. Question number 20. What do you mean by credit risk? The answer is, credit risk is defined as the potential that a bank counterparty or borrower would fail to meet its obligations in accordance with agreed terms. Question number 21. How do we calculate RWA? The answer is, risk-weighted assets are calculated by multiplying the exposure amount by the relevant risk weight for the type of asset or loan. Question number 22. What is Basel II? The answer is, Basel II is a second international banking regulatory accord based on three major pillars, namely regulatory supervision, minimal capital requirements, and market discipline. Question number 23. Who are business correspondents? The answer is, business correspondents are retail agents engaged by banks for providing banking services at locations other than a bank branch or ATM. Business correspondents enable a bank to provide its limited range of banking services at a low cost. They hence are instrumental in promoting financial inclusion. Question number 24. Can investors trade in stocks using their mobiles? The answer is, yes. Back in August 2010, the SEBI allowed share trading through mobiles or laptops. While some brokerage houses have already introduced share trading through mobiles. Using its proprietary Fast Trade mobile application, BSE launched mobile trading on September 22, 2010. Question number 25. What is an ECB? The answer is, an ECB stands for External Commercial Borrowing. It is a commercial loan availed by domestic companies from non-resident lenders abroad for a minimum maturity of 3 years. Many Indian companies and financial institutions raise ECBs as interest rates abroad are much cheaper when compared to India. RBI permits companies to borrow through ECBs in two routes, one is automatic route and the other is approval route. Question number 26. What is an FCCB? The answer is, FCCB stands for Foreign Currency Convertible Bond. Some of its features are, it works as a financial instrument through which companies raise money, as it has features of both a bond and a stock, so it's a hybrid instrument. It is a bond that can be converted at the option of the bondholder into an equity share at a predetermined price and after a specific period. It provides regular yield to the bondholder during the period. As the name suggests, it is denominated in a foreign currency. Question number 27. What are Basel III norms? The answer is, as per Basel III norms, banks have to raise their Tier 1 capital from the present 2% to 4.5% by 2015. In addition, they will have to set aside another 2.5% as contingency capital, with which the total capital adequacy ratio would go up to 7%. Indian banks are not likely to be impacted by the new Basel III norms by the governor of the RBI. It may take some more time for RBI to come out with its guidelines on Basel III norms, as these norms are still evolving. Question number 28. What do you mean by crystallization? The answer is, when an import bill is not paid within 10 days period from the due date, banks will convert it into rupee liability to honor their commitment and make payment. Such a process of conversion is called crystallization. Question number 29. Why is it important for the government to support MSME? The answer is, MSMEs are an important sector of the Indian economy and have contributed immensely to the country's socio-economic development. It not only generates employment opportunities but also works hand in hand towards the development of the nation's backward and rural areas. Question number 30. When does an agricultural loan become NPA? The answer is: in the case of a short-term loan, the 2 crop seasons do not exceed 2 half years, while in the case of long duration 1 crop season does not exceed 1 year a crop from the due date of installment or interest. In the case of miscellaneous agricultural activity where income is going to be generated daily or monthly like dairy, the NPA classification is once again similar to P segment or SBF advances. For more such videos, subscribe to our channel.